Imagine sitting at your desk, just, having a normal afternoon, watching an asset you own drop by $160 in the exact time it takes to watch a standard movie.
Yeah, a really short movie at that.
Right, just 90 minutes. Because on the evening of June 17th, 2026, gold was sitting comfortably around $4,380 an ounce. The market felt, well, totally stable, and then the floor simply vanished.
It was a brutal vertical drop. I mean, just straight down. The price plummeted to the $4,220 region before anyone could even blink.
Welcome to the deep dive. And before we really get going, just a quick reminder for you to like the video, subscribe to the channel, and definitely drop a comment down below with your opinion on all this. We love hearing from you.
We really do.
So today I am joined by senior market analyst Michael Anderson. We are looking at a stack of urgent market bulletins, financial analysis reports, just a whole pile of data covering this incredibly jarring event.
And it was jarring for pretty much everyone on the trading floor.
Exactly. Our mission for you today is to dissect the hidden forces behind this massive reversal, right? We want to move past that initial panic and understand how four distinct market pressures converged at the exact same moment to force this drop.
Right, because it's never just one thing. It's a convergence.
Yeah, and we also need to figure out what it actually means for the broader financial landscape.
Wow.
So, okay, let's unpack this, starting with the raw scale of the damage.
Well, the scale is definitely what demands our attention first.
Yeah.
It wasn't just a bad afternoon of trading. It was a systemic shock that dragged the entire precious metals complex down with it.
Including silver, right.
Oh, absolutely. Silver fell in perfect synchronization. It dropped from a peak of roughly $71.50 straight down to $67 in that identical 90-minute window.
Wow.
Yeah, a $4.50 drop for silver is just massive. It really showcases just how aggressively capital was fleeing the space.
So we have the crime scene. Let's look at the prime suspect here. According to the analysis we're holding, roughly 60% of this decline lands squarely on the shoulders of the U.S. Federal Reserve.
Right, the Fed.
But here is the piece that might seem counterintuitive at first glance, especially if you're just reading the headlines. The Fed kept interest rates completely unchanged that day. I mean, they didn't hike rates at all.
No, they didn't. They held the line on the actual rates. But they deployed what analysts call hawkish signals.
Meaning they talked tough.
Exactly. During their communications, committee members indicated a really strong lean toward the possibility of further interest rate hikes later in the year.
So they didn't pull the trigger, but they definitely showed everyone the gun.
Yeah, that's a good way to put it. They essentially signaled to the market that their fight against inflation was not over. And that completely caught traders off guard.
Wait, so if the Fed just hinted at future hikes without actually raising rates today, why did the market react so violently?
Well, what's fascinating here is that markets, they don't trade on today's news. They trade on tomorrow's expectations.
Right, the forward-looking nature of it all.
Exactly. Reuters noted that market expectations for a December rate hike spiked from 61% up to 78%, literally just on those signals alone.
Just on the possibility.
Yes. They abruptly had to reduce their expectations of monetary easing. The market had fully priced in, rate cuts. So when that changed, it triggered a massive global reassessment of asset values.
Which brings us back to gold. And to understand why gold cares so much about an interest rate hike that hasn't even happened yet, you have to look at the metal's core nature. I always say gold is like an expensive painting.
I love that analogy.
Right. It's valuable, it historically appreciates over time, but it doesn't pay you a monthly dividend just for hanging on your wall.
Exactly. It's a zero-yield asset. And when you are managing billions of dollars in institutional capital, you are constantly weighing opportunity costs.
Meaning, what else could my money be doing right now?
Precisely. Prior to this Fed meeting, the narrative was that the central bank was going to start cutting rates, meaning the cost of borrowing goes down and the yield on safe assets drops.
Which makes yielding assets like government bonds pay out less, making our expensive painting look pretty attractive as a safe place to park your wealth.
But then the Fed flips the script. Suddenly, the prospect of a higher guaranteed return on government debt later in the year makes holding a zero-yield asset incredibly expensive in terms of lost potential income.
Because you could be earning that sweet, sweet interest instead.
Exactly. So institutions just start dumping the non-yielding metal to prepare their portfolios for those higher-yielding opportunities.
The forward-looking nature of the market is just wild to observe. I mean, traders aren't reacting to the economy of June 17th. They're aggressively repositioning for the phantom economy of December, based on a few words from a central banker.
Yeah, a few very carefully chosen words.
But the Fed's statement was really just the catalyst, right? It immediately bled into other financial instruments, specifically the US dollar and Treasury bonds, which our reports flag as being responsible for another 20% of the crash.
That's right. Following the Fed's message, the U.S. dollar index actually ticked up,
Okay.
which brought it to roughly 100.4 points. And at the exact same time, 10-year U.S. Treasury yields simultaneously soared. They went from roughly 4.430% up to around 4.455%.
And the reports say they even touched 4.47% briefly.
They did. And that combination, a rising U.S. dollar plus rising yields, that is historical kryptonite for gold.
Because gold is priced in US dollars on the global market. So if I'm a buyer holding euros or yen, a stronger dollar instantly makes gold more expensive for me to buy.
Right. Your purchasing power drops, so demand naturally suppresses.
And then you throw in the rising Treasury yields, which means the US government is literally offering you a better cash payout to just hold their debt.
It's a brutal dual pressure system. It squeezes precious metals from both sides. We're really looking at competing safe haven assets here.
Yeah.
When bonds start paying out more, capital naturally flows away from the shiny metal and toward the guaranteed government payout. The opportunity cost simply becomes too great to ignore.
Okay, but I want to push back on that safe haven aspect for a second, because our sources highlight a major geopolitical variable that was happening at the exact same time.
The Iran situation.
Yeah, there were expectations of easing tensions regarding an Iran deal, but then President Trump explicitly warned that the deal wasn't final and that military action remained a possibility. Now, we're not taking political sides here. We're just looking at the market variables reported in the data. But wait. If a major political figure like Trump is warning that military action in Iran is still on the table, shouldn't investors be flooding into gold as a safe haven?
You would totally expect that. I mean, gold historically acts as the ultimate hedge against geopolitical instability.
Right. Fear usually equals gold buying.
Exactly. The reports do note that this geopolitical tension provided a floor. It provided some support for gold. But ultimately, it wasn't enough to offset the pressure from the Fed and the dollar.
Why not, though? A potential conflict seems like a pretty big deal.
It is, but if we connect this to the bigger picture, we have to understand the hierarchy of market drivers. Geopolitical anxiety is abstract. It's a fear of what might happen.
Okay, yeah.
But a surging U.S. dollar and high Treasury yields, those are concrete mathematical realities happening in real time on trader screens.
The math beats the fear.
Exactly. In this specific instance, the gravity of a strong dollar and those high yields simply overpowered the geopolitical anxiety.
That makes a lot of sense. And there was another fundamental variable acting as a headwind too, right? Oil.
Yeah, oil was a big factor.
The reports show oil prices had been surging, but they suddenly stalled out. And since oil is a massive driver of consumer prices, cooling oil means cooling inflation concerns.
Which means the Fed might feel justified in keeping their policy tight, which just adds even more pressure to precious metals.
So the fundamental picture is clear. The Fed spooked the room, the dollar strengthened, yields went up, and the geopolitical fears weren't enough to offset the shifting math.
Spot on.
But the time frame is the piece that still feels so unnatural to me. I mean, losing $160 in 90 minutes, that is simply too fast for human beings reading reports, having a quick meeting, and casually calling their brokers to sell.
Oh, absolutely. Human traders do not move that fast, which means we are moving past human economic decisions and into the mechanical realities of modern trading.
The algorithms.
Exactly. Our sources attribute the final 20% of this massive decline directly to technical and algorithmic selling.
Okay, here's where it gets really interesting. It sounds like someone tripped on the stairs, the initial Fed news, but then they crashed into a massive domino display.
That is a great way to visualize it.
Right. The algorithms are the dominoes. The initial human selling pushed the price down, but it didn't just find a resting place. It breached a critical support zone.
And once that floor was breached, the trading machines just took over and amplified the momentum entirely.
And from my reading of the reports, a support zone is just a psychological price level where historical data suggests buyers usually step in to defend the asset.
Yeah, it acts as the floor. But modern institutional trading is heavily automated. Funds use algorithms programmed with strict instructions to protect their capital.
The stop-loss orders.
Exactly. They have these orders clustered by the thousands just below major support zones. They are basically telling the computer, if the price drops below this specific dollar amount, sell my position instantly.
Before I lose my shirt.
Right. So when the initial panic pushed the price through that floor, it tripped all those wires simultaneously. You get a massive influx of automated sell orders hitting the order book all at once.
And if there aren't enough human buyers waiting to absorb that avalanche of selling?
The price has to drop further and further to find anyone willing to buy, which then hits the next level of stop-loss orders deeper down.
Wow.
Yeah, creates a cascading effect, a stop-loss sweep. Add in margin calls, where funds are automatically closing out positions because they're overly leveraged, and you get that crazy 90-minute free fall.
It's ruthless. And looking at silver, you see this dynamic amplified even more, right?
Oh, significantly.
I mean, silver dropped $4.50 in that same window.
Because silver is a smaller, less liquid market than gold. When speculative sentiment slows down, silver usually falls faster than gold. It really highlights the sheer ruthless efficiency of these algorithmic sell-offs.
The machines don't care about the nuance of the Fed's words. They just execute code.
Exactly.
Okay, so we've mapped the anatomy of the crash. We know the fundamental triggers and the mechanical amplifiers. But stepping back from the wreckage of June 17th, the real question for you listening is, what happens now?
Right. How do we process this going forward?
The reports indicate the market has entered a phase characterized as cleaning and a revaluation of expectations.
Yeah, cleaning is basically industry talk for a washout.
Getting rid of the weak hands.
Exactly. The highly leveraged speculators have been forcibly removed via those margin calls. The market is now trying to figure out what a fair price for gold actually is under the shadow of these potential rate hikes.
So looking at the short-term outlook, the extreme volatility is probably not over.
Highly probable that it continues, yes.
The analysis points to the $4,200 to $4,250 range as the new crucial defense zone.
Right.
And if $4,220 is broken, the reports warn we could see another wave of that technical sell-off.
Because more dominoes are waiting down there. And on the flip side, resistance sits at $4,320 to $4,380.
It's going to bounce around between those walls for a bit.
Almost certainly.
So what does this all mean for you? If you're looking at your portfolio and you see this wipeout, it's easy to panic. But if the long-term trend isn't broken, is this just a dramatic pothole on a long highway?
That's a great question, and yes, that confirms the broader view. The overarching uptrend is not broken.
Okay, that's reassuring.
It's just not going to be a straight line up anymore. The long-term thesis is still heavily supported by several factors.
Like the central bank gold purchases.
Exactly. Sovereign nations are still buying physical gold at a massive scale to diversify their global assets.
Right, de-dollarization.
Yes. Plus, you still have the overarching monetary policy shifts and those underlying geopolitical risks we talked about. A central bank managing national wealth doesn't panic sell because an algorithm triggered a stop loss on a Tuesday.
They play the long game.
Exactly. But we do need to issue a word of caution here based on the strategy notes in the reports.
Right, the playbook for navigating the chaos.
Yes. The primary warnings include not chasing rallies after sharp increases. If it jumps up $30, don't just assume the bull run is back on.
And conversely, don't panic sell after a single decline.
Exactly. You have to monitor the big three: the US dollar, Treasury yields, and oil. The key takeaway isn't to guess tomorrow's exact price, but to prioritize capital management.
Protect your downside.
Always. You wait for clearer policy signals from the Fed before reacting emotionally.
So to briefly recap our journey today, it all started with a change in tone. A hawkish hint from the Fed triggered a spike in yields and the dollar.
Which created that hostile math equation.
Right. Which then tripped a mechanical avalanche of algorithmic selling, erasing $160 of gold's value in just an hour and a half.
It really is incredible when you lay it all out like that.
It is. And for you listening, understanding these interconnected layers, from central bank whispers to automated trading scripts, that is what keeps you truly well informed.
Much better than just reacting to scary headlines.
Exactly. Now, before we wrap up, I know you had a final thought you wanted to leave everyone with.
I do. Because going through all this data, it raises an important question for you to mull over. We've seen that 20% of a massive crash was driven entirely by unfeeling algorithms executing preset commands in literally milliseconds.
Yeah.
So the question is, in a market like that, are human investors reacting to the actual economy anymore, or are we just reacting to the machines?
Oh, wow. Are we trading the reality of the economy or just the wake of the algorithms? That is definitely something to think about the next time you see a chart suddenly fall off a cliff.
It really is.
Well, thank you so much for joining us on this deep dive, and thank you all for listening. Just a final reminder to like, subscribe, and comment. We hope dissecting this event helps you see the invisible gears turning beneath the daily news. Have a great, well-informed day of learning ahead.